Think index funds and ETFs are the cheapest way to invest. What if I told you hidden brokerage fees could be silently eating away at your returns, potentially costing you more than actively managed funds? Before you invest another dollar, discover the shocking truth about the real costs of index funds versus ETFs. Index funds and ETFs are both investment tools that allow you to invest in a basket of stocks or bonds rather than picking individual securities. They both aim to track a specific market benchmark like the S&P 500. This gives you instant diversification. However, there are some key differences. ETFs, or exchange-traded funds, trade on an exchange just like individual stocks. This means their price can change throughout the day based on supply and demand. Index funds, on the other hand, are bought and sold directly from the fund company. Their price is determined at the end of the trading day based on the fund's net asset value, or NAV. One of the biggest differences is how you buy and sell them. Because ETFs trade like stocks, they offer more liquidity. You can buy or sell them anytime the market is open. Index funds are less liquid, as you can only buy or sell them at the end of the day. Liquidity matters when you want your assets to be available when you need them. Both index funds and ETFs are known for having low expense ratios. The expense ratio is the annual fee you pay to cover the cost of managing the fund. However, ETFs also have brokerage commissions. If you buy and sell ETFs frequently, these commissions can add up and eat into your returns. Index funds generally don't have these commissions when bought directly from the fund, but this depends on the brokerage. For instance, brokerage fees could potentially cost you more than actively managed funds. This is especially true for those with cost-conscious approach with smaller investments. Minimum investment amounts can also differ. Some index funds require a minimum investment, while you can buy just one share of an ETF. This makes ETFs more accessible to investors with less capital. Finally, there are tax implications to consider. ETFs are generally considered more tax efficient than index funds because of how they are structured. They potentially generate fewer capital gains taxes. So, which is better for your portfolio? It depends on your individual financial goals and investment strategy. If you're a frequent trader who values liquidity, ETFs might be a better choice. If you're a long-term investor looking for a simple, low-cost way to invest, with smaller initial investments, an index fund with no transaction fees through a brokerage might be preferable. If you desire a hands-off approach for long-term financial security, understanding the basics of index funds and ETFs will be useful. One question that remains is how the different weighting methodologies of index funds and ETFs truly impact long-term returns. Also, what is the optimal blend of domestic, international, and emerging market exposure within these funds for various risk profiles? These questions are important for building a truly optimized portfolio. If you found this video helpful, please like, share, and subscribe to keep watching more amazing videos.